This video will help you understand what a modified endowment contract is relative to a permanent life insurance policy. If you don't know who I am, my name is Chris Dime. I'm a financial planner out of Edmonds, Washington, and I specialize in working with folks to and through retirement. One of the more popular financial products that are marketed out there today are permanent life insurance policies. And while in today's video, we're not going to get into the efficacy of whether or not you should implement one of these policies into your financial plan, rather we're going to talk about a particular IRS designation on some policies that strip it from some of the unique tax benefits you might have been attracted to when you first bought the policy. Namely, this is a modified endowment contract label, or a MEC. So let's jump in. Of the two types of life insurance you can buy out there in the marketplace today, you can either buy term life insurance or you can buy some form of permanent life insurance. Term life insurance, as the name alludes, is insurance that's meant to exist for a particular term of time. Generally 10 years, 20 years, 30 years, or maybe like a policy that lasts until you're 80 years old but increases in cost every year. There's a number of different ways to structure these, but philosophically, these policies are designed to expire before you will most likely expire. But since the insurance company, for the most part, infallibly knows you're probably not going to die before your assumed mortality date after the policy expires, they don't charge as much compared to permanent life insurance policies. So it's a super cost-effective way of securing a lot of protection for a relatively low annual contribution. On the flip side are permanent life insurance policies, and as the name alludes here, these policies are meant to exist on your balance sheet permanently, or at least until you die. As I mentioned before, these policies will require a much higher annual contribution for the same level of death benefit as like a term life insurance policy, and roughly speaking, you can expect to pay about 10 times as much on an annual basis for the same level of coverage, if not 20 times. Now, while these policies are designed to last until the day you die, there are circumstances in where even if you paid the annual premium every single year when you first bought the policy, there's a chance this policy might not last until you die. For a brief explainer on circumstances like that, I'll link above to a short video I put out that covers some of the scenarios where this could apply. For the most part though, these policies are designed to last until the day that you die, as long as you pay your premium. Unique to permanent life insurance policies, however, is the accumulation of some form of cash value. You could analogize it to the amount of equity you own inside the policy. Now, permanent life insurance policies come in a myriad of different structures, from things like whole life insurance to variable life insurance to universal life insurance, indexed universal life insurance, variable universal life insurance, et cetera, et cetera. There's a near infinite number of different products and product structures. In addition, there's also an infinite number of, in my opinion, sleazy marketing terms that insurance brokers will use to masquerade the fact that fundamentally what you are buying is a permanent life insurance policy. Now, just because a broker might use this, of course, doesn't attribute the motive to what they're probably trying to do. Maybe they're trying to help you better understand the purpose behind this policy, but fundamentally, it's a permanent life insurance policy, and the insurance commissioner dictates that this policy must primarily be for insurance purposes. Nonetheless, you might hear terms like cash value life insurance, private placement life insurance, be your own bank policies, life insurance retirement plans, and the worst offenders are these last three, 7702 plans, which is not a real thing. Instead, it's referring to the subsection of the Internal Revenue Code that defines life insurance. But by calling it a 7702 plan, it makes it sound like a 401k or 403b or something, really official. I've even heard them called rich person Roth IRAs because it's another place where you can save money into if you make too much money to fund a Roth IRA. And the worst is a medical Roth. And that's because if fundamentally you're buying life insurance, odds are you'll need to get a medical exam completed, blood draw, questionnaire, etc. And so there's a medical vetting process before you can invest in this medical Roth. It's not a medical Roth. That's a super sleazy way of marketing it. I've actually never heard a broker use this term, but internally we have heard it passed around before. So if you hear that, that's probably a red flag. Though colloquially, we kind of refer to anything people might do or spend money on as an investment, technically speaking, and defined by the Internal Revenue Code and insurance commissioners, these policies are not allowed to be marketed as investments. They have to be marketed as insurance vehicles because fundamentally they are insurance products. Let's talk about some policy design things as we get into modified endowment contract labels. 99% of the time, the death benefit received once somebody dies will be entirely tax-free to the recipient. There are some exceptions, but that's beyond the scope of today's video. Based on how the policy is designed, that will dictate how quickly or not quickly cash value accumulates within the policy. But regardless of the speed of accumulation or the size of the cash value inside the policy accumulates without taxes. As money grows inside the account, as opposed to like an individual brokerage account, like a non-qualified account, for example, you will not pay capital gains taxes, ordinary income taxes, etc. And for most policies, you can borrow from the cash value without taxes and pay it back over time, or just die with the debt. Or you can do a straight up withdrawal of the cash value. And what's unique about most permanent life insurance policies is when you go to make a withdrawal of the cash value, you receive what's called FIFO treatment, or first in, first out, meaning the first dollars you put into the plan, you already paid taxes on, so that's considered your basis. Until you pull out enough money from your cash value to exhaust your basis, and then tap into the gains portion of the plan, all of the basis received back to you is completely tax-free. Only when you touch on the gain would that be treated as ordinary income. But again, if this policy is well designed, then you shouldn't get hit with any sort of 10% early withdrawal penalty tax, even if you're under the age of 59 and a half. So there's some unique tax benefits of borrowing without taxes and withdrawing without taxes up until your basis is exhausted. Keep in mind, a withdrawal from your cash value most likely would receive a proportional decrease in the total amount of death benefit in the plan because you're taking assets away from the plan. But you'll have to speak with your insurance agent to better understand what the ramifications will be from a straight withdrawal. Loans do not affect the death benefit gross amount. But if you die with a loan on the policy, then that amount gets subtracted from the death benefit. It's helpful to know the tax advantages of traditionally a permanent life insurance policy structure, because we're going to touch on modified endowment contracts now, and those have some changes to the tax benefits. A modified endowment contract is essentially a label that the Internal Revenue Code will stamp onto a policy that accumulates cash too quickly within the first 7 years of policy, relative to the amount of death benefit that it has. Basically, the IRS goes, this policy accumulates cash too quickly, it's too much like an investment account, even though it's still considered an insurance policy, we're gonna strip away some of those cool tax benefits I just talked about a second ago. The first ramification is now when you go to make withdrawals, if your policy is considered a modified endowment contract, you're actually gonna get LIFO treatment, or last in, first out, meaning the first dollars you pull out are going to be considered coming from the gain, and the last dollars you pull out are going to be considered coming from your basis. Keep in mind, for a modified endowment contract, if you're under the age of 59 and a half, that withdrawal will come from the gain, which will not only be ordinary income taxable, but will also get slapped with a 10% early withdrawal penalty tax, barring a couple of exceptions, and I'll link to those down below. For example, if I put 10 grand a year into a policy for 10 years and my basis is 100 grand, but my gain is 50,000, in a typical policy, I'd be able to pull out 100 grand, tax-free, no problem, other than my death benefit going down. With a modified endowment contract, however, if I were to pull out 50 grand, $50,000 would be considered income taxable to me. And as of now, I'm under 59 and a half, so I would also get hit with a 10% penalty tax on $50,000. Now, the remaining 100 grand, if I were to pull all that out too, one, my policy would most likely lapse, but that would be considered all tax-free though. Like I said though, some exceptions apply, like disability, or if you structure a substantially equal periodic payment schedule, which I'll link above to an explainer video on kind of how the IRS likes to see that broken down. It's unique for life insurance, particularly the code you look for is 72V, not 72T. But either way, the explainer video I'll link above kind of breaks it down. So ultimately, a MEC reduces the tax efficiency of using cash value. The other negative ramification of a modified endowment contract is how loans are treated. Like I mentioned earlier, typically loans are going to be completely tax-free, regardless if you're loaning out the basis or the gain in your policy. But with a modified endowment contract, we go back to that LIFO treatment, and the first dollars you're borrowing are the gain. And the IRS will consider the gain you're borrowing as a withdrawal. Therefore, ordinary income taxable and 10% early withdrawal penalty taxable. So essentially, if you're planning on using the cash value for your policy, either through withdrawals or loans, you do not want a modified endowment contract label. The good news is though, whether MEC or non-MEC, your death benefit is not affected relative to its tax efficiency. meaning whoever is the beneficiary would receive those assets tax-free. In addition, the lack of taxation you pay on the cash value accumulation, that also is consistent with a MEC or a non-MEC policy. So if your goal is to accumulate cash but not use it, or if your goal is just to die with this policy, then I suppose a MEC is totally fine. So how does the IRS test for a modified endowment contract or not? Well, Internal Revenue Code Section 7702, as I mentioned earlier, is where the IRS defines life insurance. There's two tests that an insurance agency can run to pass the IRS's test on whether or not an insurance policy is considered life insurance. Those two tests are the guideline premium test and then the cash value accumulation test. If an insurance company uses one of those, whichever test they used for this particular policy is the same test they have to use year after year for that policy. Regardless of which formula they employ, however, after it's passed, the insurance company then needs to run what's called the 7-pay test. And that's where the insurance company tests to ensure that the cash value doesn't accumulate too quickly within the first 7 years of a policy relative to the amount of death benefit you have. For example, you can't buy a life insurance policy with $1 of death benefit and shove $1 million a year into it. It's not going to work. I couldn't find any hard and fast rule on whether or not you had to fund a policy for 7 years. So I guess theoretically you don't have to, but in my experience running these policies and then getting modified endowment contract notifications if we used a particular policy design, you should plan on funding a policy for at least 7 years. So what do you do if your policy is deemed a modified endowment contract? Well, if you've already bought the policy and you're like a year or two into the policy, there's nothing you can do other than maybe decreasing your contributions into the plan. If we back up a little bit though, the insurance company should be sending you warnings if your policy is going to turn into a MEC, and you can work with the insurance broker to right size your funding and maybe make some changes so that it doesn't violate that 7-pay test. For those of you who might have a more sophisticated understanding of insurance policies, and you might be familiar with 1035 exchanging, where you essentially move the cash value of one life insurance plan to another insurance product, life insurance, annuity, etc. You actually can't 1035 exchange a modified endowment contract into a non-modified endowment contract policy. The MEC kind of virus follows with it. So if you 1035 exchange a MEC policy, whatever you 1035 exchange into, new policy, existing policy, that will also be deemed a MEC. Essentially, once you're in MEC territory and your policy has been stamped with a MEC, you should just basically plan on this policy being used as a permanent life insurance policy for death benefit only, unless you want to deal with some of the tax ramifications that come along with it if you were to pull out some of the cash value. So can a modified endowment contract be a good thing? Yes, it absolutely can. In fact, there's a number of different policies that are designed to MEC because the people buying these policies don't care about the cash value. They care about the life insurance, which again, fundamentally is what you're buying. Super popular examples would be things like single premium universal life insurance policies, where you essentially say, hey, I've got 500 grand here, insurance company. If I give you 500 grand today, how much life insurance will I have? And what will that life insurance accumulate to before I die? But I'm not going to give you any more money. That's a super simple equation for the insurance company to run. And it's a super simple way of buying future death benefit. That policy will be a modified endowment contract, but who cares, because you're not planning to use the cash value anyways. For most policyholders, however, I would argue a modified endowment contract is most likely going to be a bad thing. One of the more attractive reasons why people buy these insurance policies is because they accumulate a side fund and the customer is thinking they're going to use that side fund at some point in the future tax efficiently. So from a cost to action standpoint, number one, know what you're buying. If you do not understand it, I'm going to highly recommend take time to discern the policy. I promise you, the insurance company that wants to sell you this policy is not going anywhere. And if they are going somewhere, you'll thank me for taking time to discern whether or not to use them, because you don't want your insurance policy with a financial institution that's going to go under. So take your time, think through it, and prayerfully understand what you're buying. But there's also an infinite number of ways in which these policies can be structured, with various bells and whistles and guarantees and riders, or we'll call those like additions to the policy. Things like, hey, if you become disabled, the insurance company will pick up the tab. Or if you have a long-term care event, you can use a portion of the death benefit, if not all of it, to pay for those long-term care insurance costs. Some of these are going to be beneficial, some will not be beneficial. There is a price, whether explicit or implicit within the policy, through either reduced cash value accumulation or less death benefit, to pay for these additions, however. A couple other things to know is 99% of these permanent life insurance policies are still sold on a commission basis. The industry is trying to move away from that, but fundamentally, most policies sold today are sold and then pay the insurance broker a commission. Commissions, though not inherently bad, do set up a hard time in discerning a conflict of interest, however, because it's an immediate compensation for something the insurance broker doesn't need to continuously service. And like I said, the industry is trying to move away from that, but just know that walking into it. On the topic of commissions as well, as far as a little bit of inside baseball here, how the policy is designed will directly influence how much commission the insurance broker gets. The insurance company wants you to buy more death benefit. They don't necessarily want you to buy more cash value. And so when the insurance broker is structuring this policy, the faster they design it to accumulate cash value, the smaller their commission will be. We don't have time to get into a crash course on policy design, but just know that if you want to have the most cash value focused insurance policy, you probably want to structure something with the smallest amount of death benefit that you fund a bunch of money into and then stop in that 7th year. If you put in an 8th year's premium, the policy would become a modified endowment contract. And so that 7 years, you're kind of decreasing the death benefit and then shoving as much cash into it as possible to ideally accumulate cash value as quick as possible. Either way, hope this was helpful in explaining what a modified endowment contract is, as well as some context if you're walking into buying a permanent life insurance policy. If you have further questions, I'd say drop them in the comments below, but we've had to pause comments for now, so you can get in touch on the website. Also find me on other social media platforms if you want to as well. I'll link all that down below if you want to get in touch. Either way, wish you a wonderful rest of your week, and we'll talk to you later. Bye.